Welcome everyone to this VAT update recording as part of our November FD seminar series. I'm going to be running through some topical updates and helpful reminders, as well as providing some guidance on how to be prepared for any dealings with HMRC. I'll begin by giving a short background on when HMRC may have contacted businesses to review their VAT affairs in the past and how that has changed in recent times, followed by some recent changes we have seen with HMRC and how Brexit has impacted HMRC's behaviour in the UK. Topical updates I will run through include VAT in the digital age, a reminder on the place of supply rules, particularly around the purchase of services from overseas suppliers, VAT implications of recent news stories, before concluding with a few helpful reminders. Generally, in the past, HMRC VAT inquiries have arisen for 3 or 4 main reasons. You've submitted a VAT return containing values which HMRC's system would not expect to see for your business or similar businesses operating in your sector. Your accounts or tax returns submitted to HMRC might be inconsistent with the VAT returns that you've submitted. There might be fraudulent activity ongoing in your sector, or it could just be a random selection. These are all still ways in which HMRC are inquiring into businesses' VAT affairs, but in addition, HMRC's current approach is to look at areas of VAT that they don't like, where perhaps there's scope to change the VAT law, or where they believe traders commonly make mistakes. Once an area has been identified, HMRC will set out their understanding of the rules and their view of the position before setting up specific task forces to approach businesses in an effort to generate revenue from an under-declaration or overclaim of VAT. And some of the areas that we've seen this include second-hand motor dealers, the cosmetic industry, and businesses operating in the UK without a fixed establishment, particularly those selling goods through online marketplaces. We often hear about some of these project teams in advance and therefore have a bit of a heads up on where HMRC may start targeting businesses. And hopefully you'll see from the next few slides why we think it is crucial to ensure your VAT affairs are in order now, and if you have any concerns, to seek professional advice rather than waiting for HMRC to come knocking. So what else has changed and why is it such a problem? It is not likely groundbreaking news that HMRC's VAT departments are under-resourced and inexperienced. Some of you may think that is a kind choice of words to describe the position, and you're probably not wrong. In the past, although we may not have thought it at the time, we were actually able to get hold of HMRC fairly easily, and in most cases were able to speak to someone who was experienced and knowledgeable in the area of VAT that our cases required. Then HMRC began closing physical offices, and many of the more experienced staff left HMRC. HMRC have since turned to temporary staff, or hiring people straight out of school or colleges, but with a lack of experienced staff to train them. This has resulted in businesses seeking advice from HMRC that is just incorrect at times. Just this week, I had a HMRC refuse a VAT repayment for a trader of just over £5,000 because they believed it was submitted out of time. After speaking with them and showing that actually they confirmed themselves that the claim was submitted on time, they simply advised that we needed to put that in writing to appeal the decision rather than just reversing the original decision, which was clearly incorrect. We've even seen cases through the courts where taxpayers have relied on such guidance, only to find themselves on the other side of a courtroom table against HMRC, arguing a different position to which they originally advised, raising large assessments and winning in the courts. This results in significant time, effort, stress, and costs to resolve the matter, which in some cases may have been avoided in the first place by seeking professional advice initially rather than going directly to HMRC, particularly where the consequences for getting it wrong are significant or unknown. Most of you listening would have experienced issues trying to get hold of HMRC, and unfortunately I expect this is only going to get worse. HMRC have taken the decision to only allow 2 methods of communication for each VAT department, be this by phone, email, web chat, or post. We are lucky enough to have a number of internal contacts at HMRC, which is extremely helpful, but businesses shouldn't have to pay for professional advisors to liaise with HMRC on their behalf. The new VAT registration service. There have been no end of problems with this, whether it's UTRs being required, the system rejecting partnership registrations because one of the partners is already involved in a VAT registered business, a fault in the system HMRC themselves don't seem to be able to identify or fix, or just a string of queries being raised before the registration is processed, which anyone with a basic understanding of VAT would be able to determine are not relevant. But it's okay because we've got a fallback option, the paper application form, which can be sent in for manual processing, except that's going as well. This could impact any business looking to buy or sell a business or part of a business, or those looking to enter or leave a VAT group, particularly if the timing is crucial to avoid an irrecoverable VAT charge. Another significant change which wasn't advertised by HMRC was the removal of their discretion to not charge interest on overclaimed or underclaimed VAT, where there's been no overall loss of revenue, what they call commercial restitution. In fact, HMRC's own guidance is still incorrect in places, despite some of it being updated after the 1st of January this year when the change occurred. To help demonstrate the effect of this change, I've included an example scenario on the slide here. So imagine you're acquiring a commercial property which you intend to trade from, but the acquisition is being handled by the group holding company. Let's say the property is opted to tax and is being sold for £1 million plus VAT. The vendor raises an invoice for the sale to the trading company, but the invoice has been addressed to the holding company, a simple administrative mistake. As a result, the invoice is processed and VAT reclaimed on the holding company's VAT return as normal. Let's assume their only income is taxable management charges to its subsidiaries. Perhaps during an audit, the invoice is reviewed and it's brought to the FD's attention that the invoice is incorrectly addressed and should have been made out to and claimed by the trading company. This is a VAT error, and due to the value of the error, HMRC need to be notified using an error correction notice. The holding company will need to repay the wrongly claimed VAT to HMRC, which the trading company will be entitled to claim upon a receipt of an amended invoice. As the VAT would have been claimed in full by the fully taxable trading company, HMRC never really would have had the benefit of that VAT, even if the error hadn't have occurred. Prior to the 1st of January this year, HMRC would almost certainly not have charged any interest on the error. Any penalties raised may have been fully mitigated or suspended, and this simple administrative mistake may have been dealt with without any real financial consequences. However, the same error occurs this year, and the interest has to be charged at the Bank of England base rate plus 2.5%. Given the high interest rates, using the dates and the values in this example, this would have risen to an interest rate charge of just under £10,000. On the flip side, this does mean that if an error occurs in the taxpayer's favour, then interest will be due from HMRC, although this is at the lower rate of the Bank of England base rate less 1%. So a rare benefit of HMRC's current staffing issue is that any repayment claim over £100,000 needs to be authorised by a higher officer at HMRC, and there are currently only 2 higher officers dealing with such claims, which has led to significant delays of between 6 and 12 months at times. The final slide before we move on to the topical updates is simply to demonstrate the effect Brexit has had on HMRC behaviour. VAT law is primarily an EU tax written into UK legislation through the VAT Act and secondary legislation. Prior to Brexit, this meant the UK had to follow EU rulings and any changes to the principal VAT directive and other EU regulations. Following Brexit, the UK's had more freedom to make changes to the UK legislation, which we've already seen with the extension initially of zero rating for e-books, and more recently the widening of the exemption for healthcare services through the provision of supervised pharmacists. However, the EU still makes up a significant proportion of the UK's trade, and so it's very likely that any EU VAT rulings will remain persuasive in the UK courts, and the UK will likely follow mainstream changes the EU makes for commercial reason, one of which I will cover shortly. So moving on to some topical updates, one of the areas we have seen lots of discussion and publicity around is the desire to move towards all things digital and real-time information reporting. The introduction in the UK of making tax digital, which I'm sure you'll all fondly remember, was intended to reduce the tax gap created by human error through manual calculations and entering box figures manually on the government gateway. HMRC hoped to achieve the reduction in the tax gap by introducing the requirement for a full digital audit trail following entry of transactions in the digital VAT account through to submission. This is just one change towards digital and real-time reporting, but the UK is way behind the curve in comparison to a large number of other countries worldwide, and it does not look like this is going to change going forwards. That being said, HMRC are slowly continuing to follow those countries and move in this direction. Those of you who have imported goods in the past or do so regularly may recognise the screenshot here of the yellowy green import VAT certificate or C79 issued by HMRC. These were sent in the post every month, showing the import VAT a business has paid and can therefore claim on their next VAT return. HMRC's old customs handling system, known as Chief, automatically generated these. However, despite beginning the process 6 or 7 years ago, the system has slowly been replaced by a new Customs Declaration Service, or CDS. Chief was effectively turned off for imports back in October last year, which meant the paper certificates also stopped. But we've come across many businesses that were, and some that still are, unaware of this change, resulting in them continuing to pay the import VAT up front, but those preparing the returns have not been claiming the import VAT because they haven't received those certificates in the post. What you now need to do is sign up to access the CDS through your government gateway account and download these statements to claim the import VAT. An alternative would of course be to use postponed import VAT accounting, or PIVA, provided you own the goods you're importing and you'll be using them wholly for business purposes. The PIVA statements are also downloaded online, but rather than the C79s, the import VAT isn't paid up front, but it's included on the VAT return in which the statement is received. And for most businesses that are fully taxable, the same amount of VAT will be claimed on that same VAT return. This obviously results in a cash flow advantage, which is very beneficial given the current economic climate. During our last FD seminar series, we received some queries on the introduction of e-invoicing, with many receiving letters calling for action to prepare for this change. This is something that already exists in some EU member states, but the requirements vary from country to country. The EU are still looking to require all EU member states to adopt e-invoicing, but will need to regularise this across the EU and get the timing right. And it's anticipated that this won't happen until 2028, although we're already hearing talk of delays until 2029. And it's likely the UK will follow suit, but probably not until the EU regularise the position. We will, of course, monitor the position and update you of any changes. But for now, I would just stress that different countries do have different invoicing regulations. So if you have any overseas registrations, make sure you're following the correct rules in those countries. And if you have customers overseas, check with them to ensure you are including any specific wording or content they require to process the invoice, mostly to ensure that they process your invoices for payment without delay, an issue we have seen many businesses face in the past. This might mean different invoicing requirements for different customers based on the location of supplies, so it may be worth checking your software and invoicing procedures will be able to cope with this given the inevitable change in the future. This next slide is a simple table, or simple for VAT terms, on the basic place of supply rules for services. I won't go through in detail, but what we have seen with the increase on remote working, artificial intelligence, and improvements to IT and cybersecurity is an increase in supplies without full details of where the supplier or the customer is located. And this may lead to overseas obligations to register for VAT, where customers belong outside the UK, or customers having to account for VAT under the reverse charge, on services purchased from overseas suppliers. These are often missed by those processing transactions, so it's important to ensure proper procedures are in place and due diligence carried out to avoid errors or complications prior to sale or purchase, especially for any businesses that have a restriction on input VAT recovery. In addition to these basic rules, certain services have special rules which can move the place of supply within or outside the scope of UK VAT, such as land-related supplies, often where the land is located, digitally supplied services, where they're used and performed, and intermediary supplies in certain situations, which may follow the VAT treatment of the underlying supply. If you're unsure, always check with an advisor at an early stage when costing supplies. Unfortunately, we won't have time for a game of Have I Got News for You, but the point I wanted to make here is that VAT crops up everywhere. There are many news stories and emerging areas that have direct VAT implications, some more obvious than others. The first story here looks at the laws for developers to improve countryside and wildlife habitats and the delays in implementation. One of the reasons for this is the complications and uncertainty around the tax and VAT implications. We have been actively engaging with HMRC and stakeholders to obtain certainty around the VAT treatment of environmental credits, such as voluntary carbon credits and biodiversity net gain, as there is little guidance and differences in treatment between essentially very similar supplies which needs to be addressed. The second story is clearly about VAT and the desire for a particular political party to make private school fees subject to VAT. Whilst this may be of interest to a number of you if you have children attending school, this is also an example of what on the face of it looks like a very simple change, but is actually much more complex. This would require a change to the current VAT legislation, despite recent reports, and may not result in the desired effect, with perhaps more private school students forced to attend state-funded schools, increasing the strain on resources and reducing the increased revenue expected from the change. The last two stories both relate to building regulations and the need for improvements to building structures, which may result in irrecoverable VAT costs. We have been involved in live cases on the cladding point and the scope of VAT reliefs where the works related to the original construction of the building, which had never been signed off as complete, and whether the additional works could qualify as snagging. And we expect to see more on the rack concrete development, particularly around the potential scope for reduced rating in certain cases where conditions are met. So the evidence is there. VAT is popular and it's interesting, and there is always more than meets the eye. This final slide is a reminder of some of the VAT considerations covered in earlier FD seminar series, which are still relevant or cross over with some of the topics mentioned in other recordings as part of this series. I talked earlier this year about transactions between group companies and other collaborative working arrangements and the VAT pitfalls. When recharging costs, it's important to understand whether these are disbursements and outside the scope of VAT or supplies for VAT purposes. If supplies, are these supplies of staff and generally subject to VAT without VAT grouping, joint contracts of employment, or if they are recharges for common directors? Or are they separate supplies of services and subject to VAT depending on the service that's being provided? If intercompany loans are provided, is there a potential impact on VAT recovery for the company's overhead costs, either because interest is charged on the loan and therefore an exempt supply, or no interest is charged and it's considered a non-business activity? Electric vehicles are still coming up regularly in conversations, and remember, if a business provides charging for electric vehicles, VAT must be accounted for on any charge made, or if provided free of charge, you must restrict input VAT recovery on the property's electricity costs. If you provide bikes to employees under the Cycle to Work scheme under a salary sacrifice arrangement, remember to account for VAT on the salary deductions. And finally, there's been recent complex tribunal cases around the VAT recovery of deal costs for transactions. This has always been a complex area and one we've provided much support and advice on. What recent cases has shown is that there continues to be ways in which VAT can be recoverable on deal costs, but care needs to be taken in the structure of the deal and the parties engaging with suppliers. This is particularly relevant for businesses on the seller side, as typically VAT exemption applies to share sales, and VAT is not recoverable in relation to exempt supplies. But there are arguments where the business sold is taxable in nature, and in certain circumstances, some costs may be seen to relate to that taxable trade. However, as the case law demonstrates, you should always seek expert advice on this area, and if you have queries, I'd be happy to point you in the right direction.